In this week's video, we'll review the latest charts to help us answer the question, what does history say about multiple rate hikes and stocks for the remainder of 2022? Got a lot to cover, so feel free to use the pause button on your video player. This is the S&P 500 index during the trading session on Friday, January 28th. This is our 4 to 15% drawdown chart that we've covered several times, looking at hypothetical drawdowns from this peak up here. During Friday's session, we're still hovering near the 200-day moving average in red and near the 10% drawdown level here. Thus, any of the commentary that follows in this video that was recorded on Thursday does not need to be altered in any way. This is a press release from the Federal Reserve dated January 26th that was released at the exact same time that the statement was released this week from the Fed. Title of the press release, Principles for Reducing the Size of the Federal Reserve's Balance Sheet. Might be helpful to take a moment and look at open market operations, QE, quantitative tightening, and balance sheet reduction from a very, very high level. When the Fed decides to raise or lower interest rates, they do not just issue a statement or a memo. They do so via a process known as open market operations. When they lower interest rates or ease, they basically create electronic money at the Fed. They pump that money into the system, and the way that they do it is they exchange that money for securities, typically U.S. Treasury bonds. The Fed creates electronic money, and the way that they get it into the system is they buy assets. And for typical open market operations, they typically buy short maturity U.S. Treasury bonds. So think of it this way. Money goes into the system, assets, securities come out of the system. That's how you ease. This process is similar to QE, but we'll circle back to that. When you raise interest rates or tighten monetary conditions, the Fed basically does the opposite. They take one of the bonds that they own, sell it to somebody, and when they do that, they're removing liquidity from the system. A bond goes into the system again, money comes out of the system. This is somewhat similar to quantitative tightening. Quantitative easing, for the most part, is very, very similar to open market operations that they use to lower interest rates. The difference is typically quantitative easing is done when interest rates are already at zero or when the Fed wants to target a specific portion of the market. Remember, we said normal open market operations targets relatively short-dated maturity U.S. Treasury bonds. Typically with QE, the Fed tends to go after longer-dated paper and sometimes a very specific area, such as mortgage-backed securities. So QE, like open market operations to lower interest rates, eases monetary conditions. So think of it this way. They inject money into the system when you're doing QE, and the bond goes on the Fed's balance sheet. And when the bond on the Fed's balance sheet matures, they typically go back into the market and buy another bond and keep the process rolling. Under quantitative tightening, when the bond matures on the left side of the screen on the Fed's balance sheet, they basically retire that money. They take it out of the system. Quantitative tightening, a bond matures, they basically just let that money sit there. So it too is a form of reducing liquidity in the system. So operationally, quantitative easing really has been going on forever in the form of open market operations. It's just a little bit different. The mechanics are basically the same. What they target can be a little bit different, and when they do it can be a little bit different. From a conceptual perspective, raising interest rates, and when they raise interest rates, remember they do that through normal open market operations, and quantitative tightening, both of them are designed to pull liquidity out of the system. Now let's circle back to the Fed's press release and see what we can learn. Once again, principles for reducing the size of the Federal Reserve's balance sheet. And remember, it's the bonds that are on their balance sheet. They create money, it goes into the system, they pull bonds out of the system. Those bonds are on their balance sheet. So the text on the right side of your screen comes directly from the press release. The Fed is planning to significantly reduce the size of their balance sheet. This is really important right here. The committee views changes in the target range for the federal funds rate as the primary means of adjusting the stance of monetary policy. What does that mean? That means the primary way to adjust rates is the traditional way, through open market operations. They're going to sell relatively short-dated U.S. Treasury bonds. They'll go back into the system, and they'll be pulling money out of the system. Remember, quantitative tightening is when a bond matures, you basically take that money out of the system by not reinvesting it. How they plan to reduce their balance sheet is primarily by adjusting the amounts reinvested of principal payments received from securities. So when a bond matures, some of that money will be retired and not reinvested. Here's a key point. The committee is prepared to adjust any of the details of its approach in reducing the size of its balance sheet in light of economic and financial developments. Raising interest rates via open market operations and quantitative tightening, all of it speaks to reducing liquidity in the system. The concept of reducing liquidity in the system is not new. It's happened every time the Fed has raised rates in its history. The market's concern relative to quantitative tightening is if you set that on autopilot, you're basically saying there's a part of monetary policy that's not particularly flexible and it's on autopilot. And that typically is what the market doesn't like. And the press release did contain significantly reducing the size of the balance sheet. It does speak a little bit to the concept of being on autopilot. The term autopilot is what spooked the market in Q4 of 2018. Thus, going forward, the more flexible the Fed appears to be about how they're going to reduce the size of their balance sheet, most likely the better it will be for markets. The more they make predetermined statements about where they're headed, the less markets will like it. Why? Because if the economy starts to go south and they're on autopilot, it makes it sound like they're very inflexible in terms of responding. And one of the ways they address that is right here. The committee views changes in the target range for the federal funds rate, which is again traditional open market operations, what they've been doing for years. Notice they say it's the primary means of adjusting the stance of monetary policy, meaning they're acknowledging that quantitative tightening impacts interest rates, impacts liquidity in the system. And as long as they take that into account and don't get on any preset course relative to what they're doing with the balance sheet and/or interest rates, it may not be a problem. How about ending quantitative easing? If we were to ask a question, taken in isolation, is ending QE a showstopper for the stock market? Well, let's look at what happened when they ended QE2. It officially ended on June 30th, 2011. What happened in the stock market walking forward from June 30th, 2011? Well, initially, there was a very, very big drawdown. And this drawdown is somewhat beyond the scope of this video. There's a lot of factors in here related to Europe and a potential default on U.S. Treasury debt. But the end of QE2 absolutely is a factor as well. But given the S&P 500 gained 93% from this low in October of 2011 and almost 61% from the end of QE2, which is June 30th, it's very, very difficult to say, taken in isolation, that the end of quantitative easing means the stock market is doomed. We heard the same thing in here, and this is what happened. This rally lasts from October of 2011 into the spring of 2015. We've already shown at a very, very high level that raising interest rates and quantitative tightening are somewhat similar in that both drain liquidity from the system. So we just said, taken in isolation, does the end of QE spell gloom and doom necessarily? Hard to say that with this chart in front of us. How about raising interest rates? S&P 500 from the beginning of 1982, lower left-hand corner of your screen, all the way up to the peak in the year 2000, upper right. During this secular bull run, the S&P 500 gained 1,146%. Thus, it might be helpful to ask and answer, how many times did the Fed increase interest rates between point A and point B? Answer, 32 times. And that means 32 times over this period, the Fed drained liquidity from the system. And here's a little more detail. For example, in 1988, the Fed increased rates 4 times in that calendar year. Also noteworthy, headline from last week, the U.S. economy grew 5.7% last year, the fastest expansion since 1984. 1984 occurs within the context of that secular bull run. So what else can we learn about the Fed raising interest rates and stock market performance from our friend Ryan Dietrich and LPL Research? Table shows you, going back to 1970, years that featured multiple rate hikes from the Fed. So for example, the Fed raised rates 8 times in 2005. The full year S&P 500 return was 3%. If we look at the present day chart of the S&P 500 as of the close on Thursday, January 27th, you can see we're still hanging around that upward sloping 200-day moving average. Very, very difficult at this point to say we've lost the magnet look. As long as we're somewhat hanging around this area here, that's not too bad. And we all know markets are forward-looking mechanisms. The market knows that the Fed's going to raise rates. The market knows that the Fed was talking about reducing its balance sheet, and thus it's already fallen 9.22% year-to-date as of January 27th. Well, given that these are full-year returns, that tells us that even in these cases here where the Fed raised rates multiple times in a calendar year, if we followed a similar full-year path in the present day, it's really not going to get much worse. We're already down 9.22%. In 1971, if the full-year return was 10.8%, that means we've got a lot of work to do if we're down 9.22% year-to-date. In fact, if the present day closed with a gain of 10.8% at the end of the year, we would have to gain 22% from the present day to hit that target. So if year-to-date we're down 9.22%, if the full year return was down 9.7%, would we need to sell anything? No, we wouldn't. If it was down 11.5%, we really don't need to sell anything there. That's about a 2% drawdown from here. In these cases, the pain starts to get a little more significant. So relative to where we already are, the market is a forward-looking mechanism relative to these years where the Fed raised rates multiple times. You can make a very, very rational argument that if something similar played out between now and year-end, 89% of these cases tell us the rest of the year from here wouldn't be that bad. And only 11% or 2 of the cases, this case here and this case here, notice it's 1973 and 1974, that would still be pretty painful. And if we're going to get to 10.8% at the end of the year and we're down 9.22 now, we would need to gain 22.06% from where we are today to finish the year up 10.8%. And that would mean that we would follow a path similar to 1971. If we do the same calculation for all of these cases, in the cases where the S&P 500 had a full year return that was positive, they're up here. Why are we looking at it that way? Because the market's either going to be positive or negative at the end of the year. It can't be both. So if the bullish case wins out and the bull market remains intact, the average gain from here, hypothetically, relative to history, would be about 23%. The median gain would be the same. How about these years where we're red? What would happen between now and year end if we were ending up with a loss of 29.7% at year end? Right here, from where we are today, we would have to lose an additional 22.56%. But even in these cases where the market lost money during the full year, to get to these numbers at year end, on average, we would only have to lose an additional 3.79%, because we're already down 9.22. The median loss to get to these levels, 1.5%. Doesn't mean everything's fine in the present day, but what it's telling us is, even in years where the Fed raised rates multiple times, in every single one of these cases, the Fed is draining liquidity from the system. And quantitative tightening will drain liquidity from the system. All of that says, in many of the cases, the path between here and year end could be very, very satisfying. And even in the cases on average, might not be that bad. Now let's shift gears to a few things that we might be looking at to try to determine what the risk is of this market evolving into something much worse, or possibly making a stand somewhere near that 200-day moving average. This is a daily chart. Here's the big plunge here, the low that we had earlier in the week on the 24th. This is as of the close on the 27th here. All things being equal, if we come down and try to retest this area, we'd like to see some divergences, multiple indicators, and we'd also like to see some breadth divergences. Here's the look of the pullback, July 24th, 1996. You can see we have a similar profile to January 25th of 2022. Earlier this week, we had breadth data that was similar to what was seen on March 9th of 2020. You can see on March 9th of 2020, the market looked quite a bit worse than it did on January 25th, but you could easily see us morph into something like that. It's well within the realm of possibility. So how this is helpful, if the present day chart starts to look more like the right side of the screen, we should get more concerned. If it looks more like the left side of the screen, we should be more patient. What happened in each of these cases walking forward? The total drawdown in the 1996 case on a closing basis was 7.64%. From the closing high to the intraday low, it was 10.7%. You can see for the most part, we make a stand here. And as we've shown before, we rallied from this low here, 18.21% into year end. That's almost the polar opposite of what happens over here. The additional loss from March 9th of 2020 to the low on March 23rd was a painful 18.54%. So for clients, this gives us something to manage against relative to two extremes, a bullish extreme and a bearish extreme. During the session on January 27th, we're still somewhat in between. Hard to make an argument that this here looks discernibly different from this here. It's also hard to make an argument that this here is immune to morphing into something like this over here. And there's a number of things that we can look at to try to differentiate and compare March of 2020 on the right side of the screen with January of 2022. One of those ways is looking at credit spreads. So after the Fed meeting, how did the credit markets look? They looked very, very tame. Here are credit spreads as of the close on January 26th. Here's that gigantic widening of credit spreads during this period here. So it's very, very difficult to look at the credit markets and say the credit markets look similar to March. March of 2020 is in here. This is the present day here. As we've mentioned before, credit spreads can widen very, very quickly. So we have to keep an open mind about what happens next. Quote from the Wall Street Journal this week told us that household balance sheets basically look the best they've ever looked since they've been tracking data back to the 1980s. Think about this quote here. The biggest challenge for the economy right now is not demand, but supply. I don't know about you, but if you're running a business and this is your problem, it's a good problem to have. And a big part of this quote-unquote problem is the favorable demographics that we've talked about for quite some time. The market's looking very, very nervous in here, no question about that. A lot of downward momentum. But credit conditions in January of this year are still much, much better than they were here. This is the early 1970s over here where my cursor is. This is 1980 right here. Notice the access to credit. Trust is low in here. 1973, 1974 bear market. Fed raised rates several times. The stock market got absolutely pummeled. 1977 was also one of the worst years on that chart. 1981, also one of the worst years on that chart. Very, very difficult to say that the present day looks similar to this period over here relative to fear and access to credit. This core durable goods orders recently broke out of a 12-year consolidation box. Is it possible that this trend is slowing? Absolutely, positively, yes. The trend is still clearly up. There was a strong trend in that same data here. We only have data going back to 1992. Very, very strong trend into the year 2000. Stocks did well from October of 2002 into late 2007. Here's the trend in this data set that still looks healthy in the present day. Let's cover another example for clients relative to how we would try to differentiate between the good case on the left side of the screen and the concerning case on the right side of the screen relative to the present day. NYSE new highs minus new lows. Earlier this week, we got down in the vicinity of negative 800 over here where my cursor is. There's data here going back to 1982, and you can see a level like that's it's rare. 1987, right there, that tells you something. 1998, there was a big drawdown in the S&P 500. So let's zoom in over on the right side of the screen. And these cases can be relevant. Why? Because in this case, in 2018, the market's trend profile is pretty constructive up here. So the S&P 500's profile in September of 2018 still looks pretty good. The S&P 500's profile in February of 2020 still looks pretty good. And that's true in the present day as well. So if we're going to get a relatively strong snapback as we did in these two cases, then this can help us with what we should be looking for. You'll notice the market bottoms here. New highs, new lows. Over here, they never make it back to the center line or zero until after the low. Here's the low. You can see the line here. That occurs basically on the other side of the low. Never happens over here while the market's falling in this area here. So in the present day, we haven't made it back either. So if we look more like this, where we still have white space in here, that would tend to add to our concerns. If we can make it back to zero, in both of these cases, that happens after the low was in the S&P 500. This wouldn't be an axiom that would be set in stone, but if these cases are similar, we can learn something about probabilities if we can get back to the zero line on a closing basis, or if we can't get back to the zero line. Intraday on Wednesday, we did get back to the zero line, but we have not done so on a closing basis. However, if we do, we'd like to get some idea of what that meant historically. So we wanted to know in the bull market cases, because we're currently in a bull market, the trend still looks like a bull market until proven otherwise. What happened when new highs, new lows dropped below 784, or they hit negative 785, and then they were able to get back to zero, which is exactly what happened here. We went down that low here, we got back to zero, market bottomed. Went down here, eventually got back to zero, market bottomed. You can see there's a handful of cases here. You have to hit this green line to be considered, and then you have to get back to the zero line. So let's focus first on the potential bad news if that were to happen. We wouldn't necessarily be out of the woods. The average maximum one-year drawdown, once you got back to the zero line, in the S&P 500 was about 5%. The median drawdown was about 4%. That's the bad news. The good news is in every case, after you got back to the zero line, the market was higher 1 year later with an average gain of 20% and a median gain of 18%. Now, if the chart of the S&P 500 and the other information that we follow starts to morph into something that looks more like early 2008, or let's say September of 2000, early 2001, then you can take this analysis and throw it in the trash can. But we're not there yet, so it's still relevant. It's also relevant that this is not a signal yet. We have not reached zero. It could happen, it may not happen, and we'll learn something either way. And since these drawdowns here were still relatively uncomfortable, we looked at the threshold that we needed to get over in the historical cases to get those drawdown numbers down. And this matches common sense. If you go back to 0, that's not as good as going back to the range between a +2 and a +195. So if you can get above the center line and break into this range here, the probabilities get even better. And none of this is relevant in the present day unless we can get a close either at or above the 0 line. It's a daily chart of the NYSE Composite during Friday's session, January 28th. You can see thus far in this area here, we're holding at similar levels to here in September of last year, here July of last year, go all the way back to May here, and even April here. We also got a market that's hanging around a 200-day moving average. In terms of getting new information, this chart, like the chart of the S&P 500, is in somewhat of a holding pattern. We'll learn something if we move in this direction here, and we'll learn something if we can recapture the 200-day moving average. Right now, we remain in a consolidation box. Tweet from Bespoke during Friday's session. Here's the Twitter handle. Sentiment. American Association of Individual Investors, bearish sentiment this week above 50%. We see something similar happen in the past. S&P 500 performance looking out 1 year, median gain 15%. Your 3 cases where you're red: dot-com bust, financial crisis. If we're headed for something like that, the charts that we've covered this week will break down in a meaningful way. That may happen. Hasn't happened yet. Another tweet from Friday's session. Evidence suggests retail sentiment is now the worst since April of 2013. When sentiment gets rarely lopsided one way or the other, in a bullish manner, if everyone's answering the question, are you bullish? Yes, you can infer that for the most part they're fully invested. And we get extended in the other direction into rare levels, a lot of people have already raised cash. And sometimes that cash can fuel rallies, as it did from that point in mid-April of 2013. From this point here, the S&P 500 gained almost 37% between April of 2013 into the spring of 2015. Tech versus bonds during Friday's session, January 28th, trying to make a stand at an upward sloping 200-day moving average. We're holding above this consolidation box that we were watching during 2021. Very similar to some of the other charts that we've covered, somewhat of a tweener look here. Gold versus the S&P 500 popped above the 200-day moving average down here earlier this week. During Friday's session about midday, it was back below it. You can see the ratio came up into this area here, acted as resistance previously, and acted as support previously. Right now, we have step 1 of a probabilistic trend change. We would need to see 2 other steps for those odds to improve. Just providing an updated look during the session on Friday, January 28th of the chart that we've already covered. Inflation is obviously a big wild card this year. From Friday's session, 4.9%, fastest gain since 1983. And we all know that 1983 occurs within the context of that secular bull run that started in 1982. It did not end until 18 years later in calendar year 2000. Thus far, 10-year yield or interest rates have held below that 50% retracement here that we've covered in the past. That's the 50% retracement of this A to B drop here. During the session on Friday, January 28th, things don't look particularly good yet. We haven't had that much improvement. However, sentiment and a lot of the very oversold readings that we saw in some breadth indicators earlier this week tell us we should keep an open mind about the market making a stand, especially some type of bounce in the coming sessions. And as we've discussed earlier in this video, one of the most important things year to date is how much we've already lost. Because in terms of redeploying cash, it's all about risk and reward. So even in these years where the Fed raised rates multiple times, to hit these levels, these full year levels that we already covered, a 22% gain between now and year end is pretty attractive. And that's because we've already dropped 9.22%. And reiterating, even in the bad cases, on average, the drawdown from here would be less than 4%, and the median drawdown between now and year end, in terms of how we would finish the year hypothetically, would be less than 2%. As always, we have to balance risk and reward. There's enough out there right now telling us to be open to redeploying some of that capital. As always, we'll take it day by day and see how it unfolds. We all know none of this works unless we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.